Cryptocurrency has taken the financial world by storm, offering a decentralized and secure way to transact in the digital realm. At the core of this innovative technology lies the blockchain, a distributed ledger system that revolutionizes how transactions are recorded and verified. What is blockchain? Blockchain is essentially a chain of blocks, where each block contains a list of transactions. These blocks are linked together using cryptographic principles, creating a secure and transparent record of all transactions conducted on the network. Once a block is added to the chain, it is immutable, meaning it cannot be altered or tampered with. Key features of blockchain. Decentralization. Unlike traditional centralized systems, blockchain operates on a peer-to-peer network, eliminating the need for intermediaries like banks or financial institutions. Transparency. All transactions on the blockchain are visible to all network participants, ensuring accountability and trust in the system. Immutability. Once data is recorded on the blockchain, it cannot be changed retroactively, enhancing security and integrity. Security. The use of cryptographic algorithms and consensus mechanisms ensures that data on the blockchain is secure and resistant to fraud. How does blockchain work? When a transaction is initiated on the blockchain network, it is broadcasted to all nodes on the network. These nodes validate the transaction using consensus mechanisms such as proof of work, POW, or proof of stake, POS. Once validated, the transaction is packaged into a block along with other transactions and added to the chain. Use cases of blockchain technology. Cryptocurrencies. Blockchain serves as the underlying technology for popular cryptocurrencies like Bitcoin and Ethereum, enabling secure peer-to-peer transactions. Smart contracts. Blockchain facilitates the creation and execution of smart contracts, self-executing contracts with predefined rules and conditions. Supply chain management. Companies utilize blockchain to track and verify the flow of goods across the supply chain, enhancing transparency and traceability. Identity management. Blockchain can be used to securely store and manage digital identities, reducing the risk of identity theft and fraud. The future of blockchain. As blockchain technology continues to evolve, its applications extend beyond cryptocurrencies into various industries, such as finance, healthcare, real estate, and more. The potential for blockchain to revolutionize business operations, streamline processes, and enhance security is vast, making it a key player in shaping the future of technology. In conclusion, understanding the basics of blockchain is essential for anyone interested in delving into the world of cryptocurrencies and decentralized finance. Its decentralized nature, transparency, and security features make blockchain a groundbreaking technology, with far-reaching implications across multiple sectors. Embrace the power of blockchain and unlock a world of possibilities in the realm of cryptocurrencies and beyond. Cryptocurrencies have ushered in a new era of financial autonomy, allowing individuals to take control of their assets in a decentralized manner. Cryptocurrency wallets play a pivotal role in this ecosystem by providing a secure means to store, manage, and transact digital currencies. Understanding cryptocurrency wallets. A wallet in the world of cryptocurrency is akin to a digital bank account. It consists of a public address, which serves as your receiving address, and a private key, which acts as your password to access and manage your funds. There are several types of cryptocurrency wallets, each catering to different needs and preferences. Types of cryptocurrency wallets. Hardware wallets. These physical devices store your private keys offline, providing an extra layer of security against online threats. Popular hardware wallets include Ledger Nano S and Trezor. Software wallets. These wallets exist as software applications that can be installed on your desktop, mobile device, or accessed online. Examples include Exodus, Electrum, and My Other Wallet. Paper wallets. A paper wallet involves printing out your public and private keys on a piece of paper, offering an offline method of storing cryptocurrency. Online wallets. Also known as web wallets, these wallets are accessible through a web browser and are convenient for quick transactions. However, they are more susceptible to hacking risks. Key features of cryptocurrency wallets. Security. Wallet security is paramount in the world of cryptocurrencies. It is essential to choose a wallet that employs robust encryption and security protocols to safeguard your funds. Backup and recovery. Many wallets provide backup options to secure your private keys in case of loss or theft. It is crucial to follow best practices for backup and recovery to prevent the loss of your assets. User-friendly interface. A good wallet should have an intuitive interface that allows users to easily send, receive, and manage their digital assets without complications. Compatibility. Ensure that your chosen wallet supports the cryptocurrencies you intend to store and transact with to avoid compatibility issues. Best practices for cryptocurrency wallet security. Keep your private keys secure. Never share your private keys with anyone, and store them in a secure location that is not accessible to unauthorized individuals. Enable two-factor authentication. Adding an extra layer of security through 2FA can help prevent unauthorized access to your wallet. Regularly update your wallet software. Stay informed about software updates and security patches to protect your wallet from vulnerabilities. Use strong passwords. Create complex passwords for your wallet that are difficult to guess or crack. Conclusion. Cryptocurrency wallets are essential tools for managing your digital assets securely and conveniently. By understanding the different types of wallets available, their features, and best practices for wallet security, you can safeguard your funds and navigate the world of cryptocurrencies with confidence. Remember, the key to successful cryptocurrency management lies in choosing a reliable wallet that aligns with your security needs and preferences. Embrace the power of cryptocurrency wallets and embark on a journey towards financial sovereignty in the digital age. This article provides insights into the world of cryptocurrency wallets, highlighting their significance in safeguarding digital assets and offering guidance on selecting and securing the right wallet for your needs. Private keys are fundamental to the security and accessibility of your cryptocurrency holdings. They serve as the digital signature that allows you to access and manage your digital assets securely. Understanding the importance of private keys is crucial for anyone engaging in cryptocurrency transactions. What are private keys? In the realm of cryptocurrency, a private key is a complex alphanumeric code that acts as a password to access your digital funds. It is a crucial component of your wallet and serves as the ultimate proof of ownership over your cryptocurrencies. Private keys must be kept confidential and secure to prevent unauthorized access to your funds. How private keys work. When you create a cryptocurrency wallet, a unique pair of keys is generated, a public key and a private key. The public key is akin to your account number, allowing others to send funds to your wallet. In contrast, the private key is like your secret PIN, granting you exclusive access to your funds for transactions and management. Importance of private keys security. Private keys are the linchpin of wallet security. Anyone who possesses your private key gains control over your funds, underscoring the critical need to safeguard this information diligently. Ownership verification. Your private key proves ownership of your cryptocurrencies on the blockchain. Without it, you lose control over your assets, emphasizing the significance of keeping it safe. Transaction authorization. When you initiate a transaction on the blockchain, your private key is used to sign the transaction and validate its authenticity. This process ensures that only the rightful owner can authorize transfers. Best practices for protecting private keys stored securely. Keep your private key offline in a secure location, such as a hardware wallet or a paper wallet, to mitigate the risk of online hacks. Avoid sharing. Never disclose your private key to anyone, as it grants full access to your funds and could result in theft or loss. Backup regularly. Create secure backups of your private key and store them in separate safe locations to prevent irreversible loss due to hardware failure or accidental deletion. Use multi-signature solutions. Consider using multi-signature wallets that require multiple private key signatures for transactions, adding an extra layer of security. Conclusion. Private keys are the cornerstone of cryptocurrency security, enabling users to securely access and manage their digital assets. Understanding the significance of private keys and implementing robust security measures is essential for safeguarding your funds and ensuring a seamless cryptocurrency experience. By prioritizing the protection of your private keys and adhering to best practices for their storage and usage, you can navigate the world of cryptocurrencies with confidence and peace of mind. Remember, in the realm of digital assets, safeguarding your private keys is paramount to preserving the integrity and security of your cryptocurrency holdings. Cryptocurrency exchanges play a vital role in the digital asset ecosystem, serving as platforms where users can buy, sell, and trade various cryptocurrencies. Understanding how exchanges function, their types, and key considerations is essential for anyone looking to venture into the world of cryptocurrencies. Exploring cryptocurrency exchanges. Cryptocurrency exchanges are online platforms that facilitate the buying, selling, and trading of digital assets. They provide a marketplace where users can exchange one cryptocurrency for another, or convert fiat currency into cryptocurrencies and vice versa. Exchanges vary in terms of features, security measures, fees, and supported cryptocurrencies. Types of cryptocurrency exchanges. Centralized exchanges. These exchanges are managed by a central authority and act as intermediaries between buyers and sellers. Examples include Binance, Coinbase, and Kraken. While CEXs offer high liquidity and ease of use, they are susceptible to hacking risks. Decentralized exchanges. DEXs operate on blockchain technology and allow users to trade directly with one another without a central authority. Platforms like Uniswap and SushiSwap offer enhanced privacy and security as users retain control of their funds. Peer-to-peer exchanges. P2P exchanges connect buyers and sellers directly, facilitating transactions without the need for an intermediary. Local Bitcoins and Paxful are popular P2P platforms that enable users to trade cryptocurrencies securely. Key considerations for choosing an exchange security. Prioritize exchanges with robust security measures such as two-factor authentication, 2FA, cold storage for funds, and encryption protocols to safeguard your assets. Liquidity. Opt for exchanges with high trading volumes to ensure liquidity and price stability in the market. Supported cryptocurrencies. Choose exchanges that support a wide range of cryptocurrencies to diversify your portfolio and access a variety of assets. Fees. Consider the fee structure of the exchange, including trading fees, withdrawal fees, and deposit fees, to assess the cost-effectiveness of your transactions. Risks. Associated with cryptocurrency exchanges. Hacking. Centralized exchanges are prime targets for hackers due to the concentration of funds. It is essential to store a significant portion of your assets in secure wallets outside the exchange. Regulatory risks. Regulatory changes and compliance issues can impact exchange operations and user experience. Stay informed about regulatory developments in your region to mitigate risks. Counterparty risk. When using centralized exchanges, there is a risk of the exchange becoming insolvent or facing operational challenges, leading to potential loss of funds. Conclusion. Cryptocurrency exchanges serve as vital gateways for users to enter the digital asset space and engage in trading activities. By understanding the types of exchanges available, key considerations when choosing a platform, and associated risks, individuals can make informed decisions and navigate the cryptocurrency landscape with confidence. Remember, conducting thorough research, practicing good security habits, and diversifying your holdings across different exchanges can help mitigate risks and enhance your cryptocurrency trading experience. Stay informed, stay secure, and embrace the opportunities presented by cryptocurrency exchanges in your journey towards financial empowerment in the digital age. In conclusion, mastering the basics of cryptocurrencies, including blockchain technology, wallets, private keys, and exchanges, is crucial for anyone looking to dive into the world of digital assets. Understanding these foundational concepts is key to navigating the complex cryptocurrency landscape successfully. Remember, your security and success in the crypto space depend on grasping these fundamental principles and implementing best practices. Don't forget to like, subscribe, and hit the notification bell to stay updated on future content. Thank you for joining us on this journey of discovery and empowerment through cryptocurrency education. Your support and engagement drive us to continue sharing valuable insights and knowledge in this exciting realm of digital finance. Stay informed, stay secure, and embrace the opportunities that cryptocurrencies offer. Thank you for being part of our community.